Hello, I am Yutaka Suzuki. I live and work somewhere in Manhattan. Today, I would like to talk about what is a 401k plan. This question is very broad. I need to introduce you some basics about a 401k. So let's relax and start looking into what is a 401k plan. A 401k plan is a retirement savings plan offered by many American employers that has tax advantages to the saver. It is named after a section of the U.S. Internal Revenue Code. The employee who signs up for a 401k agrees to have a percentage of each paycheck paid directly into an investment account. The employer may match part or all of the contribution. The employee gets to choose among a number of investment options, usually mutual funds. So the keys for 401k plan is a 401k plan is a company-sponsored retirement account that employees can contribute income while employers may match contributions. There are two basic types of 401ks, traditional and Roth, which differ primarily in how they're taxed. With the traditional 401k, employee contributions are pre-tax, meaning they reduce taxable income, but withdrawals are taxed. Employee contributions to Roth 401ks are made with after-tax income. There's tax deduction in the contribution year, but withdrawals are tax-free. So, let's look into how 401k plans work. The 401k plan was designed by the United States Congress to encourage Americans to save for retirement. Among the benefits they offer is tax savings. There are two main options, each with distinct tax advantages. First, traditional 401k. With the traditional 401k, employee contributions are deducted from gross income, meaning the money comes from the employee's payroll before income taxes have been deducted. As a result, the employee's taxable income is reduced by the total amount of contributions for the year and can be reported as a tax deduction for that tax year. No taxes are due on the money contributed or the earnings until the employee withdraws the money, usually in retirement. Second, Roth 401k. With a Roth 401k, contributions are deducted from the employee's after-tax income, meaning contributions come from the employee's pay after income taxes have been deducted. As a result, there is tax deduction in the year of the contribution. When the money is withdrawn during retirement, no additional taxes are due on the employee's contribution or the investment earnings. However, not all employers offer the option of a Roth account. If the Roth is offered, the employee can pick one or the other, or a mix of both, up to annual limits on their tax-deductible contributions. Let's further look into contribution to a 401k plan. A 401k is a defined contribution plan. The employee and employer can make contributions to the account up to the dollar limit set by the Internal Revenue Service. A defined contribution plan is an alternative to the traditional pension, known in IRS lingo as a defined benefit plan. With a pension, the employer is committed to providing a specific amount of money to the employee for life during retirement. In recent decades, 401k plans have become more common and traditional pensions have become rare as employers shifted the responsibility and risk of saving for retirement to their employees. Employees also are responsible for choosing the specific investments within their 401k accounts from a selection their employer offers. Those offerings typically include an assortment of stock and bond mutual funds and target date funds designed to reduce the risk of investment losses as the employee approaches retirement. There is a contribution limit. The maximum amount that an employee or employer can contribute to a 401k plan is adjusted periodically to account for inflation, which is a metric that measures rising prices in an economy. For 2021, the annual limit on employee contributions was $19,500 per year for workers under age 50. And for 2022, the limit is $20,500 per year. However, those aged 50 and over can make a $6,500 catch-up contribution. If the employer also contributes, or if the employee elects to make additional non-deductible after-tax contributions to their traditional 401k account, there is a total employee and employer contribution amount for the year. Non-deductible contributions are a contribution made by a participant to an employer-sponsored plan on an after-tax basis. 2021, for workers under 50 years old, the total employee and employer contribution amount is capped at $58,000 or 100% of employee compensation, whichever is lower. If we include the catch-up contribution for those 50 and over, the limit is $64,500. 2022, for workers under 50 years old, the total employee-employer contribution cannot exceed $61,000 per year. Including the catch-up contribution for those 50 and over, the limit is $67,500. What is employer matching? Employers who match their employee contributions use various formulas to calculate that match. For instance, an employer might match 50 cents for every dollar the employee contributes up to a certain percentage of salary. Financial advisors often recommend that employees contribute at least enough money to their 401k plans to get the full employer match. Another common question I receive is if they should contribute to both a traditional and Roth 401k. If their employer offers both types of 401k plans, employees can split their contributions, putting some money into a traditional 401k and some into a Roth 401k. However, their total contribution to the two types of accounts can't exceed the limit for one account, such as $19,500 for those under age 50 in 2021 and $20,500 for 2022. This is just an additional tip, but employer contributions can only go into a traditional 401k account where they will be subject to tax upon withdrawal, not into a Roth account. Now let's talk about taking withdrawals from a 401k. Once money goes into a 401k, it is difficult to withdraw it without paying taxes on the withdrawal amounts. So, you should make sure that you still save enough on the outside for emergencies and expenses you may have before retirement. Do not pull all of your savings into your 401k where you cannot easily access it, if necessary. The earnings in a 401k account are tax-deferred in the case of traditional 401ks and tax-free in the case of Roths. When the traditional 401k owner makes withdrawals, the money which has never been taxed will be taxed as ordinary income. Roth account owners have already paid income tax on the money they contributed to the plan and will owe no tax on their withdrawals as long as they satisfy certain requirements. Both traditional and Roth 401k owners must be at least age 59 years old and a half year, or meet other criteria spelled out by the IRS, such as being totally and permanently disabled when they start to make withdrawals. Otherwise, they usually will face an additional 10% early distribution penalty tax on top of any other tax they owe. Some employers allow employees to take out a loan against their contributions to a 401k plan. The employee is essentially borrowing from themselves. If you take out a 401k loan, please consider that if you leave the job before the loan is repaid, you'll have to pay it in a lump sum or face the 10% penalty for an early withdrawal. Now, I would like to let you know about what RMD is. RMD is an acronym of Required Minimum Distributions. Traditional 401k account holders are subject to Required Minimum Distributions, or RMDs, after reaching a certain age. Withdrawals are often referred to as distributions in IRS parlance. After age 72, account owners who have retired must withdraw at least a specified percentage from their 401k plans using IRS tables based on their life expectancy at the time. Note that distributions from a traditional 401k are taxable. Qualified withdrawals from a Roth 401k are not. Now, one of the typical questions which I often get from employees is, which is better, traditional 401k or Roth 401k? So, traditional 401k versus Roth 401k. Roth 401k came out in 2006. It is not very much before that Roth 401ks arrived. Roths are named for former U.S. Senator William Roth of Delaware, the primary sponsor of the legislation that made the Roth IRA possible. While Roth 401ks were a little slow to catch on, many employers now offer them. So the first decision employees often have to make when they join the plan is between Roth and traditional. As a general rule, employees who expect to be in a lower marginal tax bracket after they retire might want to opt for a traditional 401k and take advantage of the immediate tax break. On the other hand, employees who expect to be in a higher bracket after retiring might opt for the Roth so that they can avoid taxes on their savings later. Also important is that there is no tax on withdrawals, which means that all the money the contributions earn over decades of being in the account is tax-free. As a practical matter, the Roth reduces your immediate spending power more than a traditional 401k plan. That matters if your budget is tight. Since no one can predict what tax rates will be decades from now, neither type of 401k is a sure thing. For that reason, many financial advisors suggest that people hedge their bets, putting some of their money into each. There is a question which I always get when an employee leaves the company. That is, what should I do when I leave my job? When an employee leaves a company where they have a 401k plan, they generally have 4 options. Option 1. Withdraw the money. Withdrawing the money is usually a bad idea unless the employee urgently needs the cash. The money will be taxable in the year it's withdrawn. The employee will be hit with the additional 10% early distribution tax unless they are over 59 years and a half, permanently disabled, or meet the other IRS criteria for an exception to the rule. This rule was suspended for 2020 for those affected by the 2020 COVID-19 economic crisis. In the case of Roth IRAs, the employee's contributions, but not any profits, may be withdrawn tax-free and without penalty at any time as long as the employee has had the account for at least 5 years. Remember, they're still diminishing their retirement savings, which they may regret later. Option 2. Roll your 401k into an IRA. By moving the money into an IRA at a brokerage firm, a mutual fund company, or a bank, the employee can avoid immediate taxes and maintain the account's tax-advantaged status. What's more, the employee will be able to choose among a wider range of investment choices than with their employer's plan. The IRS has relatively strict rules on rollovers and how they need to be accomplished, and running afoul of them is costly. Typically, the financial institution that is in line to receive the money will be more than happy to help with the process and avoid any missteps. One thing you should remember is funds withdrawn from your 401k must be rolled over to another retirement account within 60 days to avoid taxes and penalties. Option 3. Leave your 401k with the old employer. In many cases, employers will permit a departing employee to keep a 401k account in their old plan indefinitely, although the employee can't make any further contributions to it. This generally applies to accounts worth at least $5,000. In the case of smaller accounts, the employer may give the employee no choice but to move the money elsewhere. Leaving 401k money where it is can make sense if the old employer's plan is well managed and the employee is satisfied with the investment choices it offers. The danger is that employees who change jobs over the course of their careers can leave a trail of old 401k plans and may forget about one or more of them. Their heirs might also be unaware of the existence of the accounts. Option 4. Move your 401k to a new employer. You can usually move your 401k balance to your new employer's plan. As with an IRA rollover, this maintains the account's tax-deferred status and avoids immediate taxes. It could be a wise move if the employee isn't comfortable with making the investment decisions involved in managing a rollover IRA and would rather leave some of that work to the new plan's administrator. Let's talk about starting a 401k. The simplest way to start a 401k plan is through your employer. Many companies offer 401k plans, and some will match part of an employee's contributions. In this case, your 401k paperwork and payments will be handled by the company during onboarding. If you're self-employed or run a small business with your spouse, you may be eligible for a solo 401k plan, also known as an independent 401k. These retirement plans allow freelancers and independent contractors to fund their own retirement, even though they are not employed by another company. What is the maximum contribution to a 401k? For most people, the maximum contribution to a 401k plan is $20,500 in the year 2022. If you are more than 50 years old, you can make an additional catch-up contribution of $6,500 for a total of $27,000. There are also limitations to the employer's matching contributions. The combined employer-employee contributions cannot exceed $61,000 or $67,500 for employees over 50 years old. Sometimes I get a question. Is it a good idea to take early withdrawals from my 401k? There are a few advantages to taking an early withdrawals from a 401k plan. If you take withdrawals before age 59 years and a half, you will face an additional 10% penalty in addition to any taxes you owe. However, some employers allow hardship withdrawals for certain financial needs such as medical costs, funeral costs, or buying a home. This can help you skip the early withdrawal penalty, but you will still have to pay taxes on the withdrawal. I want to finish this video by introducing a question about a very basic of a 401k. What is the main benefit of a 401k? A 401k plan lets you reduce your tax burden while saving for retirement. Not only are the gains tax-free, but it's also hassle-free since contributions are automatically subtracted from your paycheck. In addition, many employers will match part of their employees' 401k contributions, effectively giving them a free boost to their retirement savings. I hope this video is helpful for you and hope you enjoyed this video. Thank you for listening, and bye for now.